Hello and welcome to the lecture for Chapter 7, which deals with the theory of cost allocation. Just about every organization I can think of has common costs. They have costs that are not directly attributable to a particular product or division or customer that the company serves. And so there can be reasons for allocating those costs among those divisions, products, or customers to do different types of analysis. That type of allocation can result in a lot of arguments because it could mean that your division is seen as unprofitable, or a customer is seen as unprofitable, or maybe your favorite product is seen as unprofitable because of the way the allocation is done. So understanding how these allocations are done and why they're done is really important, whether you're an accountant or a manager of one of those functions, a product line manager, that sort of thing. So I'm going to talk about how it's done commonly and then steps that can be taken to be a bit more deliberate about the incentives and disincentives that are created by those different kind of allocation schemes. So first, let's start with some definitions. Cost object, that's anything for which you want to measure cost. So let's take my picnic table example that I've used in past chapters. Of course, I would want to measure all of the costs associated with making a picnic table if that's my main product. So that product is a cost object. I may also want to examine the cost of the department that makes picnic tables, so which includes marketing and customer service and all of those other kinds of costs. I may sell picnic tables at farmers markets, and I also sell them to big box stores like Home Depot. A cost object may be Home Depot. I may look at all the costs associated with servicing that particular customer. So it isn't something that I would necessarily do as a routine course of action, but something that I might say, I want to analyze X, so let's look at that. So it's something that would lead to a particular decision. Okay. A common cost is a cost that's shared by two or more cost objects. So examples would be human resources, the accounting department, the IT department, that sort of thing. Cost allocation is how we assign those indirect costs to the cost objects. And then the allocation base is the activity we use to allocate the cost. So it might be square footage, it might be machine hours, it might be a number of customer calls, that sort of thing. I worked in a company once that had two different divisions. As a playground company, prior to my ownership, we had a division that sold commercial products like to schools and parks and stuff. The average sale was about $25,000 for a playground. And then we had a residential division, so swing sets for people's backyards. And the average sale there was about $2,500, about 1/10. But they were still pretty upscale swing sets. Well, when we examined our overhead cost, primarily customer service and design work, we found that it was disproportionately weighted to the residential customers. If somebody was spending $2,500 on a swing set, they wanted all kinds of service associated with that, which translates into hiring people to be on the phone and on computers and on that sort of thing. Whereas commercial projects, we would get a purchase order and we would fulfill it and have very little in the way of customer service cost. So when we looked at allocating those customer service costs by a cost object, which in this case was a product line, we found that our residential sales were actually dramatically unprofitable. We ended up closing that division. We got out of that product line and ended up improving our profitability even though we reduced our revenue. So that's kind of how this type of analysis can lead to improving an organization. I would say that we picked up other product lines and those employees were transferred to the other product line, so it didn't mean we just let a bunch of people go. So the process of cost allocation is first to define the cost object. So what decision do we need to make? What result do we want to reach? Do we want to keep a product line, end a product line, pursue a customer, not pursue a customer, all of those kinds of things. Then we'll accumulate the common costs that are associated with that particular cost object, and sometimes that's called an indirect cost pool. And then we'll allocate those costs using an allocation base. In some cases, we might use multiple allocation bases if that makes more sense. The key thing here is we want to make sure that the allocation base or the activity drives the actual cost. I'll come back to this a little bit later. So there's an example in the book that I thought was pretty good about the cost of an email system for a company. So they have to have servers, they have to have technicians to keep the servers running, they have to have software that they lease and maybe some maintenance contracts, and there might be IT security cost, all of those kinds of things. So they have a total cost of $575,000 and they want to allocate that back to the different departments. So in this case, they did it based on terabytes of memory storage. So they could have chosen a different allocation base like number of emails sent or something to that effect, but they chose memory in this case and then allocated that 575 across those 4 departments based on how much memory each of them used. The important thing here, and I'll kind of connect this back to something we talked about in a previous chapter, which is controllability. So I think it's really important when costs are allocated to a particular manager's department in this case, that the user have some control over that. So if I'm going to be allocated, if I'm the manufacturing department and I'm allocated $115,000 for email, I should have some control over the actions my employees take that cause them to use a lot of email. So maybe I have policies that cause them to reduce the terabytes that they used by, I don't know, storing emails offline or something like that. So again, that's going to create different incentives. So if I allocate money against somebody's department, they want to show that their department is profitable and doing well. That's going to give them an incentive to use less of that activity. Okay. So there are a couple of external reasons that require us to do cost allocation. So for external reporting and taxes, we have to allocate production cost, which include overhead like the rent for the building and depreciation and utility cost. We have to allocate that between expenses, products that leave the facility for customer sales, and products that remain on the shelf like ending inventory. So that's an important way that we have to do cost allocation, and the same applies to tax rules. We also might be in a business that has contracts that are cost-based reimbursement contracts. So defense contractors, Boeing as an example, has cost-based reimbursement contracts with the Defense Department. Public utilities, healthcare providers have cost-based reimbursements, so they can have strong incentives to how much of the president's salary do I allocate. I think the book used an example of commercial utilities versus residential utilities. So how common cost of the, say, Puget Sound Energy are allocated to those 2 customer groups can drive the rate that you pay as an individual. So there are rules associated with this. There's a whole field of accounting, for example, for defense projects that guides how costs are allocated. So it isn't kind of the Wild West where everybody does it differently. There are rules associated with that. What I want to really focus on are the internal reasons for cost allocation. So I think it goes without saying that managers are going to try to reduce their use of common resources when they're charged for those. Okay, so if I told you that if you worked in a company and you were in charge of a particular product line and I did not allocate my research and development resources back to the different product lines, then you don't have an incentive to mitigate your use of research and development time. You will make as many demands on that department to develop as many new products, as many prototypes, kind of throw it all against the wall to see what sticks. So I'm going to have a very hard time controlling my research and development cost when all of the different product line managers are making demands on that resource that way. If instead I allocate that cost of research and development based on some logical scheme, it's going to mitigate or reduce the product line manager's use of that particular resource. Now we have to be careful that they don't choose to not use the internal resource and use some external resource. That we can't compete within ourselves that way, but that's an important reason for doing it, to try to drive their decision making to not overuse resources. And then decision control. So executives, based on how they do these policies, they can influence how resources are used throughout the company. So cost allocations is an internal type of tax. So cost allocations are increasing them causes the profits that are being reported by a product line or a division to be reduced, and then increasing the allocation rate motivates them to use less of that cost allocation. So the book gives an example of assessing human resource costs, the cost of the human resource department, based on the number of salespeople. And that's going to influence the decision that the manager of that particular division or area makes about how much they spend on banner ads and how much they spend on salespeople, right? There's a mix of what's the optimal mix of spending to result in the most profitability for that particular division. So if we allocate some of our HR cost, which means we have to place ads for hiring salespeople and interview them and test them and do background checks and all of those kinds of cost, if I allocate that based on a per salesperson amount, it's going to influence the decision that somebody makes compared to if there was no allocation. And at first it might look like, wait a minute, we're not choosing the mix. So they chose the number of salespeople to reduce the total cost. The result, it would be 40 salespeople if I just exclusive of any kind of allocation. When I make the allocation, that causes them to choose 34 salespeople instead. And at first blush, it might look like, wait a minute, we didn't the allocation didn't result in a decision that reduced the cost for this division. But if we think about the cost for the overall company of the HR department, which of course isn't free, all of those people get paid money, then it starts to make a little more sense. We have to consider the concept of externalities, so costs that are incurred outside of what we directly do. So the book gave some good examples of positive externalities. Those are benefits that accrue based on our actions. One would be we do training efforts within a company, and that makes all the employees better employees, and that benefits the company. A negative externality, which is what we usually think about when we think about cost, are examples like you pay for gas, you drive your car, it creates pollution, that creates a negative factor on all of society that you're not necessarily paying for. So allocating overhead is a way of kind of putting a price on those externalities, in particular the negative externalities that are associated with the decisions that managers make. So there's a graph, and the book goes through quite a bit of math about average versus marginal and stuff. And what I think is important here is to know that most overhead costs increase in a stepped fashion. So as an example, in our HR department, it reasons to say that if we hire more salespeople, we're going to need more HR staff, okay? But it's not going to be perfectly incremental. If I hire one extra salesperson, I don't hire one extra HR person. In this case, I think the increments are 5 or something like that. So if I hire a bunch of salespeople, I've got to bump up by one HR person. So those are going to increase in steps. And because we're going to use an average, so I'm going to use a blue curved line for my cost of HR because of the concept of opportunity cost or degradation of service. So if I have the exact number of HR people I need to maintain a certain sales force, and then I hire 3 more salespeople, that may not be enough to justify one extra HR person. Okay, so I'm not to the point where I make that step. But because now everybody is spread a little thinner, it takes more time to do background checks, it takes more time to sort through resumes, and maybe we don't get the very best salespeople because we lose out on some of them because of the length of time it takes us to get back to them. So that's a cost to the organization that really doesn't show up in an accounting system, right? There's no bill for that. but using an average cost will incorporate that opportunity cost in the space between the steps. Okay, I hope that makes that portion of the book make a little more sense. So in choosing an allocation base, the key thing here is we want to choose an allocation base that drives the particular activity that we want most directly. So it could be time spent on a project or personnel costs on a project, square footage or personnel cost, number of customers is another example, number of transactions is another example. The book gave a very good description of allocating utility cost for a factory among different divisions within the factory by square footage. And it's a common way to do it. So I have 25,000 square feet, and say I've got 10,000 and 10,000 and 5,000, I allocate it that way. Well, does that provide incentives for anybody to consume electricity, right? To conserve electricity. So if I'm assessed by square footage and I'm managing a particular division within that factory and I want to reduce my allocated cost, I'm going to argue that I don't need as much space. I'm going to reduce the space that I take, and I don't care if I leave space heaters on all night long, because that doesn't have any influence on what I'm charged for electricity. So the choice of allocation base can have a direct impact on the decisions that managers make. What they're going to do is they're going to figure out the system and make the decisions that cause them to be allocated less cost, which isn't necessarily going to reduce the cost of the company if you don't make a good choice on those bases. The chapter concluded with a discussion of insulating or non-insulating, which was kind of an interesting concept that I want you to give some thought to. So an insulating allocation scheme means that the cost that you are allocated is not contingent on the activities of another division within the company. So in that example, the utility costs are allocated by square footage, 10, 10, and 5. So what the person that has a 5,000 square feet does or doesn't do doesn't affect my allocation. Everybody stands alone, basically. A non-insulating allocation scheme in that case might be based on the activities of other people. So maybe on production volume or something like that, or some other measure where somebody else doing a good job will also help you. And the benefit here is kind of the incentives is if I choose a non-insulating allocation scheme, there's going to be incentives for people to have cooperative behavior and work together rather than against each other. So, I mean, the argument against it is that now I'm being influenced by activities outside of my control, so that's the downside to it. But the upside is less competition between divisions and more cooperative behavior, which generally is better for the company on an overall basis. So I hope you found that lecture helpful. Please don't hesitate to give me a call or send me an email if you have any questions as you work through the homework for this chapter, these two chapters. Thank you very much.